Hello friends, welcome back to another important video. In this video, we will do some practical credit related case studies which are very important for your CCP examination. Please note, these days IIBF is focusing on presenting some practical real life scenarios in front of you and then ask for your decision as a credit manager or what action you will take if this happens in your branch or office. So without wasting any time, let's start with the first practical scenario. And the first case study goes like this. You are evaluating the bank statements of a proprietorship firm Messrs Starline Decor seeking a CC limit of Rs 75 lakhs. During analysis, you identify a recurring debit of Rs 50,515 on the 5th of every month for past 6 months. The proposal does not mention any such term loan. This EMI does not appear in the balance sheet or in the proprietor's individual CIBIL report. When questioned, the borrower claims that the EMI pertains to a small equipment loan taken just 3 months ago and that CIBIL has not yet updated it. You observe that for one particular month, the EMI is missing on the 5th but appears as a cash deposit followed by ECS debit on the 7th. The closing balance on the 4th was only Rs 12,000 against an EMI obligation of 50,515. No statement of account has been provided for this loan and the narration shows the EMI being debited from the firm's current account even though the loan appears to be a personal obligation. As the credit manager, what is the most appropriate interpretation? Now the first option is ignore the EMI since it is a small loan and does not impact the CC limit materially. Then second option is treat the EMI as a hidden liability, insist on statement of account, consider the bounds indicated by insufficient balance and treat EMI paid from business account as capital withdrawn unless the loan is part of business books. Then third option is accept the client's statement that CIBIL will update soon and continue appraisal. And last option D is assume the EMI belongs to a customer, not to the proprietor and exclude it from assessment. Now friends, whenever you see a recurring EMI in the bank statement that the borrower has not declared in the proposal, also not shown in the balance sheet and that is missing in CIBIL as well, then this is a straight red flag. Hidden liabilities are one of the biggest reasons for the cash flow stress and they directly impact repayment capacity. In this case, the EMI of 50,515 is recurring month after month and 1 month it is missing. When you check the balance on the previous day and you find only Rs 12,000 available against an EMI of 50,515, it clearly indicates that the EMI does not clear because of insufficient balance. This means there was a bounce and the borrower later deposited cash to cover it. Now friends, in credit analysis, this behavior immediately tells you that the borrower's cash flows are not strong or predictable. And the first thing you should do is to demand the statements of account because statement of account is the only document that proves the actual repayment history. That is whether it's delays, penal interest or bounce charges. As I always say, repayment schedule is just a plan but statement of account is the reality. Next, let's talk about the second angle. That is EMI being paid from the firm's current account. Friends, this is very important behavioral insight. If the EMI belongs to the proprietor's personal housing loan or personal term loan and it is getting paid from the business account, then technically it becomes a capital withdrawal. Imagine 50,515 every month, that's more than 6 lakhs a year. And those are going out of the business to fund personal liabilities. Over time, this will erode the proprietor's capital, weakens the balance sheet, impacts leverage ratios and puts stress on the working capital cycles. And unless that loan is genuinely recorded in the business books, meaning the property and the loan are both reflected in the balance sheet, you cannot ignore this withdrawal. That is why the correct interpretation of this case study is option B. That is treat it as a hidden liability, confirm it through statement of account, assess the bounce and account for the capital withdrawal impact. Now friends, before moving ahead, please note most aspirants fail in their CCP exam not because they lack knowledge but because they lack the right resources. That's why I created these two powerful books that every CCP aspirants must have. First is this 1000 series chapter-wise question bank. Now this is not a random set of questions. This is laser-focused chapter-wise exam-oriented question bank with case studies, numericals and conceptual questions, exactly what CCP asks. Hundreds of students over the years have cracked their examination using this resource. Then second book is this complete CCP summary notes. Friends, as you know, your syllabus is huge but time is limited. These crisp exam ready notes gives you pure exam value. That is concept clarity plus instant recall plus last minute power revision. In fact, these two books are enough to crack your CCP exam. You don't need any other bulky materials or any video course. And yes, I update them after every 6 months so you always get the latest content. Get the books now from the links given in description and give yourself the edge that most CCP aspirants use. Then the second case is Messrs. Horizon Polytechs, a small manufacturing unit, applies for an enhancement of its CC limit from 1 crore to rupees 1.75 crores, claiming the turnover has increased by 50% in last 12 months. The audited financials of financial year 2021-22 shows electricity expense of rupees 36 lakhs, which is averaging rupees 3 lakhs per month. However, your financial statement analysis from June 22 to May 23 shows consistent monthly electricity related outflows of only rupees 3 to 3.2 lakhs and that are routed through a credit card payment each month instead of direct electricity board payments. The borrower tells that the unit consumption has reduced due to efficiency improvements. In parallel, you also observe the check bounce entries, that is 14 inward bounces and 32 outward bounces in a year. The borrower claims that the outward bounces are due to customer defaults and inward bounces were cleared on the same day. On verification, you found that only 4 inward bounces were same day clearances and the rest were cleared 5 to 7 days later. Which interpretation reflects the correct credit perspective? And these options are given to you. That is, first option is treat electricity expense stability as normal and ignore check bounce since outward bounces are common in trading. Then second option B is accept the borrower's efficiency arguments and consider inward bounces irrelevant since they are eventually cleared. Then third option C is question the turnover claim growth due to unchanged electricity consumption, verify unit-based consumption, treat inward bounces as serious behavioral concerns and re-evaluate cash flow reliability. And last option D is ignore electricity patterns and focus only on sales as per audited statements for limit enhancement. Now friends, in this case study, the borrower is claiming a 50% increase in turnover, but the electricity payments in the bank statements are still around rupees 3 lakhs per month, which is exactly same as the last year. Now you and I both know that in a manufacturing unit, electricity consumption is one of the most reliable indicators of actual production. Sales can be inflated, invoices can be timed differently, but electricity usage rarely lies. Even if the borrower routes payment through a credit card, the underlying power consumption remains the same. If production has genuinely increased by 50%, unit production must increase. Tariffs may change, but unit consumption cannot magically drop. So the first thing you should do is to ask for 2 years of unit-wise consumption and compare it properly. If units consumed haven't increased, then the claim growth is questionable. Maybe they are actually trading, or maybe volume hasn't increased, or maybe sales figures are overstated. This is why stable electricity outflow becomes a major warning sign. Next, let's talk about the check bouncing behavior. Friends, inward check bounces are one of the strongest behavioral red flags in credit analysis. In our case, 14 inward bounces were seen and only 4 of them were cleared on same day. The remaining were cleared after 5 to 7 days, which clearly shows cash flow stress, not just technical reasons. Outward bounces can sometimes be justified because customers in semi-urban or rural markets often delay payments, but inward bounces directly tells you about the borrower's inability to honor supplier's obligation. And when the borrower cannot honor supplier payment on time, how will he serve bank's EMI on time? On top of that, a high bounce percentage combined with the delayed clearing shows deeper liquidity issues. So from a banker's viewpoint, option C is the correct and mature interpretation. That is, you must question the turnover claim, verify the units consumed, and treat inward bounces as serious indicators of weak financial discipline. And friends, this is exactly the kind of real-world analysis every vigilant credit officer must master. The next case is A sales manager submits a loan proposal of a trading firm showing sale of rupees 1.20 crores for the last 6 months. However, the bank statement of primary current account shows total credits of only rupees 55 lakhs. The credit team raises a query stating that credit submissions are low and proper churning is not visible. You investigate and borrower initially says that he has no other current account. However, after deeper discussion, he reveals that he had another current account with a different bank which was closed 3 months ago. During the first 3 months of the 6 months period, all customer collections were routed through that HDFC account because many of his customers banked with HDFC and same bank checks cleared faster. That HDFC account is now closed. Also, the borrower is willing to provide the closed account statements and is also agreeable to routing all future collections through your bank if the limit is sanctioned. As a credit officer, what is the most appropriate and technically correct decision based on underwriting norms? Now, option A is reject the proposal immediately because churning in the submitted account is low and the borrower earlier used another bank for collections. Then second option B is accept the proposal without requiring any additional statements because the other account is already closed. Then option C is obtain the closed HDFC account statements, recompute total credit submissions for full 6 months period, and if combined credits reflect genuine business, proceed with the suitable conditions on future routing. And last option D is tell the borrower to reopen the HDFC account and continue collections there because checks clearance is faster. Now friends, the correct option for the given case study is option C. And the reason why option C is correct is very simple. In real life credit underwriting, banking must match business and that picture is never complete unless you check every single account of the borrower used during the analysis window. Many sales managers make the mistake of relying only on the active account, but as I always tell you, credit summation means total inflows across all operative accounts, including those that were closed mid-year. In this case, the borrower was routing genuine business through another bank and that account remained active for half of your analysis period. If you ignore it, naturally the churning will appear low. The right step is to obtain statements of that closed HDFC account, combine both accounts and see whether the inflows truly reflect the borrower's reported sales. Once this reconciliation is done, you get the real picture of the business. Then next, once the full credit submission turns out to be logical and consistent with turnover, the credit officer's discussion shifts from genuineness of business to future routing discipline. Friends, when limits are with your bank, the lender expects maximum credit to come from their system. So after verifying the business through the HDFC account, you can put conditions like closure of other bank account or converting it into a collection account. Fact of the matter is, you don't reject a genuine case due to an incomplete document, but you also protect the bank's interest going forward. So that's why option C is the most technically correct and banker-like decision. The next case study is, a borrower applies for a 75 lakh LAP facility, that is loan against property facility, using a commercial property as security. The legal report is clear and confirms the proper chain of title for the last 15 years. However, during submission of original papers for mortgage creation, the borrower informs the bank that the original sale deed has minor damage with one corner torn, but the text of the deed is intact. The empaneled lawyer verifies and confirms that the originals match the sub-registrar's record and issues a legal vetting report certifying authenticity. The borrower requests that the bank create an equitable mortgage through simple deposit of these deeds to avoid the higher cost of a registered mortgage. However, the credit team notes that the similar past cases have led to disputes where the owners later claim that they did not intentionally deposit deeds. As the approving officer, you must decide how to protect the bank's interest while processing the customer's request. And these options are given to you. That is, first option is proceed with an equitable mortgage without any additional documentation since the deed is verified as genuine. Then second option B is decline equitable mortgage and force a registered mortgage due to damaged document regardless of borrower preference. Then third option C is proceed with equitable mortgage but ensure the borrower signs a proper executed MOE, that is memorandum of entry, confirming voluntary deposit of title deeds. And last option D is reject the loan because any damage to the title deed automatically disqualifies it from acceptance as security. Now friends, whenever we talk about the property mortgages, especially equitable mortgage, the biggest fear banks have is future disputes. And trust me, friends, most disputes in real life do not come from forged documents. They come from owners denying their consent letter. So in this case, even though the sale deed is slightly damaged, the empaneled lawyer has physically compared the original with the sub-registered digital and physical records and confirmed that the document is authentic. So there is no legal defect to the title deed. This means an equitable mortgage is legally possible. But here is the real risk. In many fraud cases across India, owners later say, I haven't deposited my documents, or I didn't know someone was taking a loan, or even my relative misled me. And due to this, banks get stuck in litigation. And that's exactly why banks today insist on MOE, that is memorandum of entry. This document clearly records that the owner came to the bank voluntarily. Then he or she has handed over the original deeds, and lastly the intention was to create a mortgage for the loan. This written declaration protects the bank. Even if tomorrow the customer says, I didn't know, then the MOE acts as strong evidence of consent. So friends, the best approach is not to force a registered mortgage which is costly, and not to blindly accept the deposit either. The safest, most practical and most bank-friendly answer is proceed with equitable mortgage but take properly executed MOE. And that's why option C is correct here. Friends, finally we have come to the last case study of today's video, and the case study goes like this. A borrower approaches your bank seeking a term loan of Rs 12 crores against a residential property located within a semi-urban village boundary. During preliminary scrutiny, you observe that the property falls within the Lal Dora area, and the borrower submits the current sale deed along with photocopies of 2 older deeds. When the file is sent for legal verification, the empaneled advocate reports that although the current deed is valid, the N-1 deed is missing an important page showing the exact plot dimensions. In addition, the advocate states that due to the property being within the Lal Dora boundary, disputes relating to past occupation or encroachment are common, and therefore a 30-year title search will be mandatory instead of a 12-year search. The borrower, however, insists that a 12-year chain is sufficient and argues that Lal Dora demarcation should not affect the bank's assessment. As the credit officer, you must decide the correct course of action before proceeding with the loan proposal. Which of the following is the most appropriate decision? And these options are given to you. That is, first option is accept the 12-year title chain and proceed since the Limitation Act protects ownership beyond 12 years. Then option B is accept the documents as submitted but require an additional affidavit from the borrower confirming peaceful possession. Then third option C is insist a full 30-year title search and demand the complete N-1 deed before considering the property as acceptable security. And last option D is reject the case outright because all Lal Dora properties are legally unacceptable for mortgage purposes. Friends, Lal Dora basically refers to village residential or commercial areas historically demarcated by a red line on village maps during the British era. Properties within this boundary often lack proper registered sale deeds and rely on occupation-based ownership, making documentation weak and legally risky for banks during mortgage assessment. Now, this name can differ in various regions of India, but concept is same. So you can see Lal Dora properties carry higher legal risk due to historically weak documentation. Hence, banks often require a 30-year title search for extra comfort. Next, a missing page in N-1 deed creates a break in the chain of title which must be rectified. Please note an N-1 deed is the immediate previous sale deed in the property's title chain showing the current owner had acquired the property. It verifies the ownership transfer from the prior owner. Similarly, N-2 is the deed before that and so on, ensuring continuity and completeness of the title chain. Therefore, insisting on a complete 30-year chain and proper N-1 documentation is mandatory before accepting such property as security. So, as far as this case study goes, the correct option is option C. Friends, with this, I hope all these practical credit-related case studies are clear. Please note all these are very important for your CCP examination. And with this, I wind up this video. So thank you, and I will meet you again in another video next week.